Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper, oil and uranium in a separate video. I'll leave a link for that in the description section below. And that video is also going to talk about an unconventional way which I'm looking to play the gold price. So make sure you go and check that out. As always, this is general commentary. It doesn't take your personal situation into account. With all that said, let's get into our first chart. So I'm going to start off with the S&P 500. And look, really, it's been another week of extraordinary price action. It's so interesting, isn't it? It's so interesting how quickly things can change. So 3 weeks ago, the S&P 500 has gone from being on the brink of an accelerated sell-off to now being up through a 10% rally and nearing an 18-month high. So it's, if you think the stock market, if you think anything's certain, it's like this is just the great example that the stock market can really do stuff to throw people. So it's all about having strategies to deal with what the market throws at us. And last week I said my best case scenario was that the market might go travel sideways, might have some sort of a consolidation, and then from there have a base to possibly go higher from. But well, look, there was no consolidation. None of this happened. It was just a rally which went straight up, and really, I find these the hardest of all when you get markets that don't pause, because these pauses that we often get in markets, they provide those classic jump on points where you get the consolidation, you get the breakout, and you get an entry, and that can make it all nice and clear cut. But you know what's clear cut and what I like as my favorite setups just does not always play out. And I think in hindsight, when I look at this in hindsight, an entry point was probably on Thursday a couple of weeks ago, just after we'd had this false break and we'd had the strong move back up above the breakdown point. But as I was saying, I was looking for that pause, not an ongoing acceleration. And this type of price action, it's just what can happen when you get a fearful market, and this was very much a fearful market 3 weeks ago, a fearful market reversing course, and you throw in stop losses from short covering, and yeah, well, you can get these big moves that can be hard to get, but if you get them, you can do quite well from them. Now, if this was just looking at this now, so it's like, you know, so where to now? Where does this go? And I look at this, and if I was looking at, say I just called up this chart, say this was an individual stock chart and I called this up, and I'm looking at the past 18 months, I'd be saying I'm bullish. I'm bullish on this stock. I'd be talking about this basing structure from 2022, early 2023. I'd be talking about the breakout from the basing structure. I'd be talking about the rally and then the retest of the breakout point. I'd mention the false break and the swift reversal, and I'd also be mentioning that the market is above moving averages, which are now again turning and starting to rise. So from that perspective, I'd be saying if this were an individual stock, this is a stock I'd want to own. I'll look at the NASDAQ, and it's the same sort of story. I look at this, and it's the same. We've got the basing pattern, we've got the big rally, we've got the pullback, this time in a bullish flagging formation. We've got the fake out break to the downside, which was responsible for taking me out of my S&P 500 position, and then we've got the swift move back up to the top side. So from that perspective, again, if this were an individual stock, it's something that I'd want to own. But of course, these aren't individual stocks. They're part of they're indices within a broader market. And the issue I've had for a while is the lack of participation. It's really been all about these, as they call them, Magnificent Seven. It's been them doing much of the work, while probably I think you'd say the majority of stocks have really been not doing anything exciting to struggling or going backwards. And I think that's evident when you look at the when you look at the S&P 500 on an equal weight basis. So this is what we have here. This is an ETF, the S&P 500 equal weight ETF, and this is what I've been using for a lot of my guidance on market participation, amongst other things. But this has been one of them, and it's still a concern. It's like I'm looking at that S&P chart, the Nasdaq chart. I'm not going to stand in front of a market that's going up, which has clear upward momentum, and say this has to go down. I think that's foolish to do that. People who do that, they end up getting run over by the market, and the market just goes on no matter what they think or how certain they are that the recession is going to cause a crash and whatnot. I think that's a dangerous game to play. I think for me, despite my concerns about the some of the breadth in the market, about how the equal weight index is performing, despite those concerns, I think the play is to the long side. I'm going to be conservative in how I play that long side, and I'm going to have an exit strategy to manage my risk for the stocks that I buy. So I'm going to be able to step back if these indices reverse course. For me, it's not so much about being 100% right and saying the market has to fall or the market has to go up. I think it's more about using a sliding scale, and it's about increasing exposure as we get that positive price momentum, which we're getting now. And then it's about pulling it back when we get the reverse happens, when the market comes back, when it gets below moving averages. We're not going 100% out, we're not going short, we're pulling back our long exposure until we get to a point where we do need to be 100% out. But that's far from being, and that has not been the case this year. This year, for the last 12 months, I've been saying is that story of being conservatively long and then adjusting either side of more longs or less longs as the price actions dictated, and then accepting that we're not going to get every turn right, and that's always going to be the case with these markets. Just having a look at the this is the equal weight, and this is the S&P 500 on top, and this just shows the that difference in performance we're getting. The S&P 500 is close to breaking up to an 18-month high. The equal weight, it's stuck back down here. We've had some positive price action where we've rebounded off the low. We're back above moving averages. That's positive. But still we're a long way from getting back up to previous highs. So we've still got that lack of breadth story, and that's why I think caution remains the order of the day, while still trying to participate in where we see upward momentum. Now, if you're getting some value, please hit that like button, leave a short comment, just tell YouTube you're watching, and you're getting value, and YouTube then goes off and shows other people. That helps me heaps, so please do that. And yes, hit that like button, hit the subscribe button if you haven't already done so. Now, let's go over and have a look at something else. I want to have a look at the micro cap ETF this week. So I often look at the Russell. This is another interesting one to look at. It's the iShares micro cap ETF. IWC is the ticker code. So interesting to look at this. It's when you look at this, any which way you look at it, I think it's still a clear downward trend. So it gets back to that issue I've got with the when I look at the equal weight S&P 500 equal weight index. And look, yes, there has been a rally off the low, and that's encouraging to see that rally. But we're still below declining moving averages. So I've got the 50 and the 100-day moving averages, and this is where I struggle a bit. It's hard to see a sustainable bull market until we get that broad participation. Now, maybe that's coming, but it's not there at the moment. It's possible this October point was the low. That is certainly a possibility, but we just don't have enough to go on yet to say that's the case. We've got this ETF. It's back at a significant resistance point. You can see this has been this series of previous lows was support. Now it's resistance, comes in at around 100. A break above that would then take the market above resistance and above the moving averages, and that would be positive. That's something to keep an eye on. It's really interesting when you step back and look at this on a weekly perspective, and I still see people on Twitter and across YouTube and wherever else going, the market's going to crash, the market's going to crash. But when you look at this, the market kind of already has crashed for a large portion of the listed securities. So this has been down as much as 43%. If that's not sort of like, crashed out sort of conditions, well, yeah, geez, you've got a high benchmark for a crash. So look, a lot of things are down and out. Maybe things can still get worse. There's no doubt about it. But yeah, keep an eye, I think, on these resistance points. We need to see that broad participation coming through to get more confident on I think for me the Nasdaq and the S&P 500. But yeah, we've got at least here we've got some clear markers to have a look at. And last thing, the US dollar index. I'm looking at the index, not the euro or any of the other currencies. Look at the index, and this could be another pressure release for the market. I've been talking about the bond yields in recent weeks. We're talking about how the 10-year yield had divergence, was hitting that key resistance point at 5%, and we've since seen those yields coming off. It's coincided with the rally in the market. I've also been keeping an eye on this dollar index. What we find now, it's below these moving averages. The moving averages seem to be starting to roll over. And it's also got that same vulnerable technical setup as the S&P 500 had about 3 weeks ago. We have a series of declining lows where the market is breaking below each low, shallow rally back, another sharp decline, shallow rally so far below declining moving averages. So this is like how where the S&P had this same vulnerability. When a market's set up like this, it opens the possibility for another swift move to the downside. S&P 500 didn't do that, and sometimes they don't, but you just got to be aware of the risk when you see this cascading type of setup appear. And that could be positive for the commodities like gold and copper. It could help underpin the stock market. Let's see how it plays out. Let's keep an eye on this one over the next week and see how it develops. So look, let's call that a wrap for this week. Thank you for joining me. Been great talking to you again. Look forward to coming back, talking to you next week. Till then, bye for now.